One by one, companies are cutting their stock dividends, and it's causing problems for those who are trying to use stock dividends for passive income and people trying to retire early. This whole FIRE movement, FIRE standing for financial independence, retire early. And even for some baby boomers that are nearing their retirement or just already gone into their retirement, kind of depending on this dividend payout for their living expenses. And that's all been taken away right when they needed the most during this coronavirus quarantine and everybody shut down. Marriott, Boeing, Ford, Delta Airlines, Darden Restaurants, the parent company of Olive Gardens, even Anheuser-Busch, the parent company of Budweiser beer, cut its dividend by 50%. But for the rest of them that I just listed, the dividend is gone. People are falling into two dividend traps. One is obviously having the dividends being removed. And the second one is the stock price falling a lot in this stock market crash. So we're going to talk about kind of what dividends are and why they're riskier than people might believe. It's okay to own some for your retirement income and using it for living expenses and such, but it shouldn't be the only income stream that you have to depend on. Hey, what's up? It's Jeffrey Lin for Stock Sessions. Again, as always, just a disclaimer, these videos aren't investment advice. This is education to help prepare you and help you understand better what you're getting yourself into. The point with investing isn't not to invest, but to understand the risks that you're taking. Sort of like you shouldn't not drive a car just because there are risks to driving. You should learn how to operate your vehicle. You should learn the laws of driving around on the road. So that's kind of what we're doing here at Stock Sessions. So to start, this video is about the dividend traps people are falling into. There's two dividend traps. One is the dividends being cut or suspended, and the other one is the stock price falling. So a lot of people just think dividends are sort of like bonds where you get money payment forever and you just keep getting this income stream. And while that's sort of true, you need to understand how stocks and bonds are set up structurally to understand the difference between them. The first thing you should understand is what's called a capital stack. And a capital stack is just kind of how a company gets funding to run the company. Usually people know about stocks down here, and then but companies, like people, they also take on debt and they borrow money. So what the capital stack is just saying who gets priority in the event of a crisis. What this capital stack is saying, this is high priority up here, and equity or stocks is low priority. Stocks don't get paid, you don't get your dividend until the debt payments are paid. If you think of a house, the debt is sort of like your mortgage. A mortgage, you borrow money from the bank, you have to make monthly payments, and eventually you have to pay back the principal. That's what bonds are. That's exactly what bonds are. Mortgage is a type of bond. So a company has to make its monthly or quarterly interest payments on its debt, just like you have to make your monthly payments on your mortgage. So the company's priorities are operating the company, paying its employees, and then paying down the debt and the interest on the debt. And then if they have any profits left over, then they could decide if they want to pay out a dividend or not. But a dividend isn't required, whereas the interest they have to pay on the debt is required. And actually, in the event that a company goes bankrupt, the people who hold the debt, people who have the bonds, those investors get whatever pieces of the company that's still available and they get their first dibs. They have priority on the company's assets, sort of like the bank has the rights to take over your house if you don't pay your mortgage. And only after that, if there's anything left, then the investors, the stockholders will get whatever's left of the company. So the stockholders, even though they have the most potential to make money with stocks, they're also the first ones to get cut. That's why stocks are usually said to be the riskiest investment, is just because bonds get priority. So that's why companies like Marriott, like Delta Airlines, are having to cut their dividends during this coronavirus pandemic, because obviously the travel industry has gotten hit the worst. And these companies have to start taking care of their employees. They have to start taking care of their properties. So they need to save whatever cash they have and keep that and have a cushion, just like any responsible person needs to have a couple months of money available for emergencies. So these companies aren't paying out dividends because they need to keep a cash cushion. So let's look at some popular stocks, popular companies that just cut their dividends. Boeing, before the pandemic hit, it was paying out $8.22 per share. This guy is now gone. Obviously, it can't pay out $8.22 per share when Boeing itself needs a bailout. And looking at Marriott, which is my favorite hotel chain, this is where I always stay whenever I travel. It's pretty sad to see that this stock has complete collapse from $150, and this guy is gone, no more. To calculate what the percentage was before the crash, you would take the dividend amount, which is $1.92, and you divide it by the share price up here. So that was equal to 1.28%. Here we have Ford also getting hit pretty badly, and yeah, the stock price has fallen from $10 up here earlier this year all the way down to about $5, and this dividend is gone. As if it wasn't bad enough that the stock price got cut in half, the dividend was also being cut. And you should kind of expect that, because if a company's stock price has been destroyed, that is not a good sign. And you should kind of expect the dividend to also be cut pretty soon thereafter, to kind of reflect that economic reality of that company not doing well and probably needing any cash that it has on hand to keep the company alive instead of paying investors a dividend. So you have to really be aware of how the company is doing, how the business is doing, how that whole industry that the company in, how that is doing, and whether the company has the ability to keep paying out the dividends or not. Because sometimes there's a trick that happens. People just look at the amount of dividends they're getting paid, the percentage, and they think, oh, maybe they're getting 5 or 6%. They're like, oh, so much better than putting money in the bank and basically getting 0% interest on your savings account. But what are the risks that come with that, and why is that dividend so high? So there are two ways that dividends can be increased. One is the healthy way, when the company is making more and more profits, the company is growing and has extra cash after, like I said, after paying their employees, after developing products and doing advertising, and then after paying off their debt, the company still has extra cash on hand, at which point the board can get together and meet and say, do you want to issue a dividend? And if they're already issuing a dividend, then maybe they would increase the dividend from $1 to $2. So that's a healthy increase when the company's doing better and it has extra cash to pay out to investors. The bad way for the dividend to increase is if, let's say, a stock falls from $100 to $50 and the dividend just kind of stayed the same. So the dividend was always just $1. So you would take how much dividend they're paying out divided by the stock price. So at $100, if the stock is $100, a $1 dividend would be equal to 1%. Not great, but better than the 0% you're getting at your savings account. However, if the stock price falls to $50, falls by half, then a $1 dividend divided by a $50 stock price is a 2% dividend. You think, oh great, I'm getting paid 2% for the dividend, but you're not realizing that the company's stock price just got cut in half. That is not a good sign for a company. That is probably not a successful company you want to be investing in. Or if you do, you got to really understand the risks. You got to understand the dividend could be taken away pretty soon, like all the examples we just showed you. So the second mistake a lot of investors make with dividend stocks is holding the stock for the dividend, even though the company is doing poorly and the stock is crashing or has crashed. Okay, with this Marriott chart, you can see, again, Marriott was paying out $1.92 per share before they cut their dividend. But let's say they didn't cut their dividend, right? Let's say they're still paying out $1.92 per share. But the stock price has fallen from $150 up here all the way down to $79. That means it's going to take more than 35 years for you to make up that $71 loss with just the dividend payout, if they keep paying the dividend. So that's not a really good long-term strategy if you have to hold something for 35 years just for the dividend to make up the loss on the stock. So the stock price is just as important, if not more important, than the dividend price that you're getting. An common misconception is, hey, stocks will come back, right? Some, if the company's good, but if the company's good, the stock price wouldn't be in the trash and the dividend wouldn't be cut. So back in the financial crisis, I actually owned Citigroup kind of up here, and I had just started investing. I didn't quite know what I was doing, and I just kind of held it through the financial crisis all the way down here. And the stock hasn't come back for the last 10 years, digging myself into a hole like a lot of people have been, and just hoping the stock comes back, because yes, some do, but you always have to be prepared for the chance that the stock doesn't come back. You have to be prepared for the chance that the dividend doesn't come back. For example, like Marriott, it might take a couple years before it makes enough profit to pay out a dividend, because the travel industry is going to get destroyed after the coronavirus. Even after people go back to work, have some money and start traveling, there's still going to be social distancing, and a lot of people aren't going to have enough money to travel, that just people probably just aren't going to stay in hotels as much. And hotels usually have to be filled at least 75 or 80% for it to start making a profit, for it to have money to do stuff with. So hoping isn't a strategy. You have to understand what your company is doing, kind of how dividends compare with bonds and bond yields and that we just reviewed, and understand the stock chart and when you should get out and kind of cut your losses. So you got to be careful with companies paying a very high dividend. You got to kind of wonder why, because there's no such thing as a free lunch or free money that people are just leaving on the table. There's kind of like a balance. If you're getting paid a lot, there's probably a higher risk. If you're paying less, like keeping your money in your savings account, then the risk is lower. So there's a trade-off to it. One of the companies that are paying the most dividends is AT&T. Usually AT&T is very stable. Everybody uses their cell phones, so AT&T is just going to keep getting payments. And because in the US, we only kind of have a couple choices for cell phone providers. We only have AT&T, Verizon, T-Mobile, or Sprint, and AT&T and Verizon are the biggest. They're probably not going anywhere. But you still have to understand how the company is doing, because just because a company has a monopoly doesn't mean it's doing a good job of it and managing money correctly so that you can keep getting your dividend. AT&T here is paying out a huge dividend. So AT&T is paying out $2.08, which equals to 6.71%. And again, you get the dividend yield, the percentage, by taking the dividend amount, $2.08, you divide it by the stock price, which is 30.97, and you get a 6.71 yield. But you want to dig in a little bit deeper. Using Yahoo Finance, you can go to a company's statistics and look at its dividend section, kind of how its dividend is performing and whether they're able to keep paying their dividend. And one of the most important things to look at is the dividend payout ratio. What this ratio says is how much of their earnings are they paying out in dividends. And right now, AT&T is paying out 108% of their earnings. So basically, they're paying out 8% more in dividends than what they actually make. So that's not really a sustainable thing to do. As you know, if you're paying out more to your credit card than you're earning, that's not going to last very long. All right, just to wrap up, whether if you already own dividend stocks or if you're looking to invest in dividend stocks, don't buy a stock just because it's showing a high dividend percentage, what's called a dividend yield. You want to look at how the company's doing. Yeah, and you have to keep monitoring how the company is doing and how the economy is doing and how that relates to the companies, just so you know whether the company can keep paying out the dividend or not. And you also need to monitor the stock chart, so you know when the stock price is doing poorly. If it starts turning into a downtrend, you want to get out of that stock. It doesn't matter how much dividends it's really paying. If you can get out of that stock early and save yourself losses on the stock, that's more than anything that the dividends could have paid you. So keeping a stock just because it's paying a dividend while the stock crashes 50, 60, 70%, that's not a winning strategy, and it'll take a very long time for you to get the money back, if ever. All right, guys, thanks for watching. Again, my name is Jeffrey Lin for Stock Sessions. And remember to hit the subscribe button, smash the like button, and leave a comment below. Let me know what else you guys want to have clarified about investing, or any tips or any lessons you guys want to see on this channel.